as everyone's coming into the room today, we wanted to share this prompt to kind of get the conversation started and invite participants to share their answers in the chat. So for those of you who are here on time and early, if you have an answer to this prompt or you want to start thinking about it, we would love to hear how you feel about, if I knew more about blank, then my institution could fund, design, or implement blank. So my example might be for a sample would be, if I knew more about like what tools most effectively minimize risk in financing local value chains, then my institution could design a fund to strengthen local food systems. So we want to just kind of get the wheels turning, especially as we have a couple more people rolling into the room right now. I'm sure there's many more examples in the room, and we would love to hear that throughout the chat during the webinar. Let's wait a couple more minutes before we jump right in. All right, I see we're almost at 40. So I will go ahead and get started. Welcome, everyone. Now that we have your brainstorming wheels turning, we can jump into today's conversation. If you don't know me, my name is Andrea Zinn, and I'm the director of CSAF. And today we're very excited to present the findings from the work that CSAF has been conducting with the International Growth Center around building evidence for agriculture SME finance. And if you don't know CSAF, I know we've invited many different colleagues from different sectors, IGC, contacts some more of like an academic crowd, as well as some of our other partners. So CSAF is an alliance of lending institutions, and we have a shared commitment to building an inclusive and sustainable financial market for SMEs in the agriculture sector. And that means working to facilitate market growth, responsible lending, and a stronger ecosystem. We have 20 members and affiliates today who are impact investors and are also supported by a network of field building partners who are interested in our collaboration and learning agenda, including building evidence for agriculture SME finance, which is why we're all here today. So we're very pleased to present this report. We've been working on it with co-funding from SAFN. It was published 2 weeks ago by the International Growth Center at the London School of Economics. And if you haven't reviewed the report yet, we'll present a few of the key findings today, but I encourage you to review the executive summary. And if you'd like to dig deeper, it will direct you towards the more comprehensive data analysis and literature review. And later in the call, we'll invite Rania Nasir from the International Growth Center to present the key findings of this report. After that, we're going to open up for a discussion, and we really want today's conversation to be a conversation with a larger group rather than a few panelists. So we're looking forward to your contributions, really hoping that you'll engage, and during the second portion of this webinar, invite you to share questions. You can share them in the chat throughout the webinar, as well as answers to the prompt that we've shared. And we'll share that prompt again later if you want to keep thinking about it. So hopefully most people on this call do have an interest, at least in agriculture finance. Before we get started, I think it's good just to share a little bit more context about why we specifically focus on agriculture SMEs. So we see SMEs as key aggregators of farmers and farmer families, whether they are cooperatives or processors that are off-taking from small farmers. And these organizations that are working across agriculture value chains are, they just have significant potential to improve rural livelihoods, strengthen food security, mitigate climate change, and create economic opportunities. And that potential increases as their access to reliable and adequate financing grows. So for those of us working in the agriculture SME sector, we often see that impact firsthand. And as a practitioner, I know I've had many meaningful visits to farmers, and when farmers or the managers of agriculture SMEs share with us that, now that the cooperative has reliable access to finance, farmers are getting paid more quickly, they have better access to inputs, and that there's overall just more stability in farmer livelihoods. I think all of us as practitioners have examples of those conversations, and my example is not isolated. Every CSAF member has examples like this. And what makes this conversation really interesting and difficult is that when we have numerous anecdotal inputs from farmers and SME leaders who can share how meaningful the relationship is with finance, and particularly finance provided by impact investors like CSAF members, we see that change happening. And at the same time, we also need to balance what we see and what we feel and these really compelling stories with rigorous ways of evaluating impact. So that means considering control groups, counterfactuals, and other types of rigorous analysis. And that kind of brings us to why we wanted to focus on evidence building. So when we embarked on this initiative, we wanted to hold both of these things in mind, both that felt sense, these compelling stories, as well as the need for rigorous evidence building. And this initiative first wanted to identify where that evidence exists. Is there evidence? And to the extent where the existing evidence is not as strong as we would like, how do we kind of dig deeper and test that? So that means not just telling the most compelling success stories, but also tracking that impact across thousands of transactions over many years. And in the long term, we believe that when we strengthen this evidence base, we can use it to make better decisions as investors, as TA providers, as donors, and governments who we collectively, and I think everyone on this call would agree, we want our time and our resources and our capital to be deployed in the most cost-effective and high-impact way. So that's some of the background for why this report was commissioned and why we're excited to have this conversation today. And I will invite Nadia from SAFIN, who co-funded the report, to share more about why evidence building is part of SAFIN's learning agenda as well.
Absolutely. Thank you, Andrea, and good morning and afternoon, everybody. First of all, I'd like to recognize CSAF and IGC for several months of work to reach this point. So well done to all of you. It's a really good report. For the audience, in case you don't know me, I'm Nadia Martinez, and I'm the new senior coordinator for the Smallholder and Agri SME Finance and Investment Network. SAFIN is basically a network of institutions across the investment value chain that are working together to improve the entire ecosystem for Agri SME finance. We're hosted at IFAD, and since our inception in 2018, through what we call our design clinics and closed debates, our members have informed the design of SME-focused investments worth or counting more than $250 million. We collaborated on this work with CSAF and IGC because we know that market intelligence in our sector is fragmented, it's weak, and it's often held sparingly by those doing the investing. I think that a robust marketplace of information that can boost the levels of reliable and verifiable intelligence will make the field more competitive and will incentivize more people to move into the space. And it's a great space, even if it's challenging. What we're all trying to do in the end is grow this market and to do it in the right way, in a way that respects people and the planet. So at SAFIN, we've created a platform basically where members build trust so that experiences and lessons are shared. This is a valuable way of gathering market intelligence, we believe, but we also know that we must work better together to reinforce that with measurable and data-backed insights. CSAF does this very well. The member data is a great starting point, and I think that the findings of this report validate what maybe may seem to some like logical conclusions, but making decisions on what we think we know without the data to back it keeps us just doing what we already know. So to be innovative, to be bold, to transform, we need to strengthen the evidence and we need to turn it into what I think is actionable intelligence. And so really that's what this work does. It improves the field in several ways. I'll just briefly name three that align with Safin's agenda. One is effective resource allocation. So if we can see what's working, we can align to do it more. Innovation and product development. So evidence can inform the design of tailored products and services that meet the needs of Agri SMEs, going to the prompt question that Andrea put at the beginning. And transparency and accountability. So knowing where the money is actually being spent and what impact it is having. So I'm really looking forward to hearing your reactions to the report and to continuing to strengthen the field for everybody. So back to you, Andrea. Thank you.
Thanks, Nadia. I really appreciate you sharing that context. Before we jump into the IGC presentation, I also wanted to invite Brian Milder to share more about the kind of framework that we're looking at in terms of bringing this evidence building further following the presentation of this report.
Thanks, Andrea. Hi, everyone. Brian Milder, advisor to CSAF. So we used a framework to organize our review, and Rania will go into more detail in a moment. But fundamentally, we're trying to understand kind of how the upstream catalytic capital, whether it's in the form of first loss, below market impact investment, loan guarantees, or other forms of concessionality, how it's affecting capital deployment. Is it creating additionality relative to what would otherwise happen in the commercial markets? And then are agricultural SMEs gaining increased access to finance? Or is the catalytic capital somehow distorting the market and crowding out commercial capital? So that's the first question. The second question is, when agricultural SMEs have better access to finance, if in fact they do, does it improve their performance and growth? And then from there, what's the relationship between enterprise performance and livelihoods in terms of smallholder farmers, workers? We think about environmental practices, both at the SME level as well as at the farmer level. And so being able to look at each part of the chain, understand the evidence, and then also layer in the role of technical assistance or business development services. There was recently an excellent report by ISF advisors in collaboration with EMEA and others, looking at BDS providers to SMEs. And so building out that evidence base as well. And we understand that context matters. There are no simple kind of yes/no questions here, but having this kind of framework allows us to break down a very large and messy marketplace and think about it in different component parts. So with that, I'll hand it over to Rania.
Thanks, Brian. Let me just share the screen. Great. I'm assuming that everyone can see it. If you can't, okay, don't worry about it. So I'll be introducing the work that we've done on the evidence review on agricultural SME finance. This review has been led by Rocco Machiavello, who is a lead academic at the International Growth Center and has been doing work on agriculture and firms. And he's also the associate professor in the management department at LSE. And Christian, who has been the project manager on this work and been working on this intensively for the last 9 months. I'll be presenting and they'll be answering questions, so feel free to grill them. Okay, so there it is. Okay, so the aim of the evidence review is first to look at what do we have evidence on, then to look at where the gaps are, what we can learn using the data collected by CSAF, and areas for future research. Now, similar to what Nadia and Andrea had said, that some of these findings that will be presented today are not going to be groundbreaking for you. And this is a good indication because it means that your instincts and assumptions while working in this space are now proven to be grounded in evidence. So just wanted to give you a bit of that caveat. So how will we go about doing this? First, we're going to go over the academic literature. So we have an extensive database of around 32,000 papers, and we looked at both papers which have been published as well as working papers. We use the academic literature to understand how much evidence there is out there on agricultural SMEs. What does the literature say, and where are the gaps? We then looked at practitioner learning. So what we did is we reviewed documents submitted by CSAF members, and there were approximately 2,000 reports, blog posts, and other documents. And we use these documents as a complement to the academic literature. So trying to understand, can these gaps in academic literature be plugged by practitioner experience, and what that experience is. Then we did data analysis. So we used CSAF loan data of approximately 7,000 loans totaling $5 billion from 81 countries. And we looked at the relational lending aspect and the lender's experience. And lastly, we're going to wrap it up by talking a little bit about the areas for future research. So this involves the impact of larger loans, as well as the shocks to and resilience of agricultural SMEs. Let's get started. Okay, when it comes to the academic literature, what we did is we had access to the 32,000 peer-reviewed economic and development journals, papers in those journals. So the figure that you see here plots the total number of academic articles written about SME finance and about microfinance. So as you can clearly see on the slide, the level of evidence in these journals of what works in agri SME finance is comparable to microfinance over a decade ago. And as time has gone on, the gap between it is massive. And the reason this is important is because in recent years, microfinance literature has shown that the impact of microfinance is nuanced and not what we previously expected it. And it's important to work on this and work on plugging the gap, because as investment in agri SME finance grows, it is imperative that we build the evidence base on agri SMEs to maximize impact. So we took the universe of papers that we had and we started filtering it down. So we removed papers that weren't on agriculture, that weren't on developing economies, or that weren't on SMEs. We removed papers that weren't looking at finance, and papers that weren't relevant to practitioners in the agri-SME space. So this is what we were left with. So in total, we will present 16 academic papers that were published in 9 different journals. So as you can see, the majority of the papers are on SMEs and developing economies. And there are only 4 papers that present evidence on agriculture, and 1 which focuses on all 3, which is Rocco's paper. So we're really glad that we have that. So this clearly shows that there's a large gap in terms of the rigorous academic evidence. However, we believe that these papers provide relevant and rigorous insight into credit constraints, impact of access to finance and on growth, and impact of access to finance on livelihoods. So what do these papers show? Well, SMEs in the coffee sector are perceived as risky, face credit constraints, while those perceived as less risky are not subject to the same type of credit constraints. Secondly, larger SMEs seem to face fewer credit constraints in comparison to small SMEs. Interestingly, targeted programs that attempt to improve access to finance for SMEs in low and lower middle income countries can be successful in their attempts to both increase firm investment and increase firm performance. It is also shown that capital constraints of agricultural borrowers are not the only barrier to investment. Uninsured risks related to agricultural production and climate faced by small-scale farmers are also a major driver for underinvestment. Moving on to the practitioner learnings. So this is the chain that Brian showed you. What we did is we mapped out the practitioner documents across the chain to see where most of the evidence lies. And as you can see on the graph, the majority of the evidence lies on the farmers and employees, the impact to farmers and employees. Now, this indicates the priority of social lenders is to understand the impact to the targeted beneficiaries. Now, what do these learnings show? Practitioners report have information across the impact chain, and they report increases in revenue, increases in yield and product quality, farmer income. SMEs tend to be incorporated more in the formal value chain and improved community welfare. So this is what the papers that we looked at from the practitioner aspect showed. However, if you scratch beneath the surface and you look at papers which have a strong counterfactual, this is what remains. So if we remove papers without a strong counterfactual, this is what we get. And this is very similar to the issues that academic papers face. It's challenging to establish large sample size and control groups in the SME space, and that's why there are only a small number of documents. Now, also, the majority of the report consisted of case studies and were tended to be more qualitative descriptions or descriptive statistics and pre-post studies. So this also indicates the gap in the evidence. Next, moving on to the data analysis that we conducted with CSAF lenders. We were interested in learning more about how repeated lending over time is related to the size of a borrower. So to investigate this relationship, we developed an econometric model, which lets us estimate the effect of lending on firm revenue, accounting for biases induced by various sources. So this is what it looks like. What we did is we progressively controlled for more potential sources of biases across the 3 different specifications. And when you look at the graph, so the y-axis represents our estimated coefficient, the x-axis represents the years of borrowing of a borrower. And what we find is that there exists a positive relationship between firm size and repeated borrowing, but that this relationship is primarily driven by larger firms establishing longer relationships. So once you control for that, you no longer observe growth, and that's what the specification 3 shows. Now, there are a couple of caveats to this. Firstly, we do not observe firms which did not apply for or receive loans, and which is why we can't draw conclusions on whether access to finance leads to firm growth or not, because it's not available in the data. Secondly, we do not observe selection out of a relationship. So it is very possible that firms that have become incredibly productive move away from social lenders towards commercial lending. If that happens, we won't be able to see that in the data. So what we did is we repeated this analysis using interest rates and loan amounts. And what we found is that interest rates decrease marginally throughout the relationship. It's approximately 0.5 percentage points over 5 years. And loan amounts increase throughout the relationship by approximately 25%. Now, all of this is indicative that repeated lending can break down barriers of asymmetric information and induce trust in a borrower-lender relationship. Another aspect that we looked at was lender experience. So we looked at different sets of questions revolving around how experience accumulated by lenders over time affects loan dispersions, the terms, and the outcomes. So we looked at this by dissecting the data by crops, countries, and crop country pairings. So crop country pairings is what we call a market. So we look at how lender experience relates to crop lending, country lending, and market lending, and how that translates into certain loan outcomes. So when we look at the aggregate credit, the analysis finds that as lenders provide more loans in a specific market, they tend to offer larger aggregate credit volumes in subsequent years. When we replicate this using interest rates and defaults, they tend to offer loans at lower interest rates and have fewer defaults. However, to what extent is this driven by lenders being strategic and choosing markets which have these characteristics, or by the experience of learning themselves, is a very interesting question and something we are interested in doing future research in. And on the topic of future research, with regards to areas for future research, here's the impact chain again. This impact chain is a great starting point where both practitioners and researchers can identify questions that are relevant for practitioners. So Brian mentioned these questions previously as well. So the high-level questions are, how does catalytic capital affect access to finance? So it's this section. How does access to finance affect enterprise performance, which is this section? And then how does enterprise performance affect livelihoods? But within each of these high-level questions, there are multitude of sub-questions that could be answered, and some of these are provided in the infographic. What's important is that it's important to note that answering these questions will help practitioners, it'll help policymakers, it will help donors and researchers, because it's essential to determine the drivers of impact and enable people to make informed decisions to strengthen the agri-SME sector. So I'll just end it by saying that these are high-level findings and primarily a subset of our work. It would be great if you look at the link and let us know if you have any questions. Thanks.
Thanks, Rania. Thanks for sharing. I want to reiterate that we feel like this is a first step and there's a lot more research to be done. And there are many challenges to why it is hard to build evidence, specifically in the agriculture SME sector. And we're hoping that the impact chain will be a starting point of where we can focus that evidence moving forward. So now I would love to jump into the discussion. And for those of you who joined a few minutes in and at the beginning of the call, I shared that we really want this to be a conversation amongst the group rather than a panel. So we'll be inviting everyone on the call for your contributions, whether they are in the chat or if you want to raise your hand and jump in. Also, if you have any questions specifically for IGC about the work, please share that in the chat as well, and we can try to answer some of those later. So to get us started, I would love to just invite some practitioners to voice how they're feeling about this evidence review. Some of the key questions that we're asking is, what resonates with you? Where did any of the findings maybe surprise you? And what's missing? Where can we dig further? So to get us started, I would love to invite Jean-Marc Debricon from Alterfine to share his practitioner perspective. Jean-Marc, do you want to tell us?
Thank you, Andrea.
Yeah, thank you.
And thank you, Rana, for this summary. Looking for evidence. Etymologically speaking, evidence is not just facts, it's basically what's obvious. And I think for us, when we are deep into portfolio management, building activities, running operations in the context of multiple crises, sometimes we lose that kind of perspective and we lose that kind of ability to distinguish what is obvious. And reading this report, for me, the first thing that was very obvious is the gap in academic literature, which is matching the gap in financing faced by agri-SMEs, generally speaking. And so that gap actually is huge, as we know from previous estimates of the $250 billion need in financing for agri-SMEs. 75 to 80% of that is unmet. Okay, and of course, if you look at frontier markets, lose value chains, it's even higher. If you look at long-term needs, it's higher. In our own countries, in our Western economies, SMEs are typically the backbone of our economies. They are super important to our economies. We talk a lot about the large corporates. They are the ones that are listed in our exchanges, but it's the SMEs that constitute the backbone of our economies. And in our low and low middle income countries of operations, Agri SMEs constitute a substantial portion of the GDP. And as highlighted in this report, there's a huge gap between what they represent in terms of GDP value and the financing that they get access to. So I would say to answer one of the questions actually that Brian put forward, is that catalytic capital helping or distorting? To me, the answer is obvious. It's not distorting. There's a huge gap and it needs to be closed. Something needs to be done. Something in the equation needs to be changed. And I think what in this report was another obvious statement, but very important statement to make, is the correlation between size and the length of the relationship between the practitioners and the borrowers. And it's not surprising, because this is, in direct alignment with previous studies that were undertaken. I'd like to mention the 2018 Dalberg USAID study mandated by CSAF that had reached the same kind of conclusion. When you look at a certain size of loans, there's a certain threshold below which your operations are simply not economical. And generally speaking, if you talk to investors and you give them the choice between assets with a long duration, a relatively low probability of default, and a relatively low loss given default, or assets with a very short duration, 6 to 12 months, a relatively higher probability of default, and a relatively higher loss given default, what do you think they're going to choose? Always the former, okay? So there needs to be some sort of incentive, something to change the equation, to basically turn the average investor's interest from the former to the latter. So something needs to change. And I'll stop there.
I appreciate that, Jean-Marc. I think there's a lot of value in having these practitioner perspectives and understanding how this evidence in reality is actually affecting the day-to-day of investors. So I would love to invite any other impact investors or CSAF members on the call to answer that same question. Do any of these findings resonate with you? Where do you feel like you still need more evidence, or what's missing in terms of where we can dig further? I see some reps from shared interest and global partnerships and responsibility on the call. If you would love to raise your hand and chime in, I would love to hear your perspectives.
Hi, Andrea.
Yeah.
Go ahead, Paola. Thanks.
Hi, everyone. This is Paola from Global Partnerships. We are an impact first investor based in Seattle. We invest in Latin America and Sub-Saharan Africa. I think something that resonates a lot from the study is the correlation between the length of the relationship and the trust that is built. And I think it's great to have the evidence to encourage other investors to make that first step, to start a relationship and to build it, because we have seen it with our agricultural partners, with most of them, we have very long relationships, and it is true. You get to know more the managers, the business, the practices that they have in place. So I think it's great to have that evidence to encourage new investors to build those relationships. I have a question, Andrea, but I don't know if you want to address it at the end. I'm curious, with this great contribution to the sector, what is CSAF planning to do in terms of maybe advocacy, or what are the next steps for this evidence?
Yeah, that's a great question. We've been reaching out to various stakeholders, ecosystem actors in the agriculture SME sector to answer that specific question and what comes next. And maybe there's different versions of that. I think there's definitely a need to coordinate and collect the evidence that currently exists and organize it in a way that it can be used to make decisions. And then collectively, I feel there's momentum to build additional evidence to commission either jointly or collaboratively, at least, new types of evidence building that can continue to build the evidence base in agriculture SME finance. So we're having some of those conversations. We have an upcoming meeting with CSAF members and field building partners at the end of June, and we'll be continuing the conversation there and hopefully continuing it very far after that as well in a more collective and collaborative way. I see a few more hands raised. Maybe we can hear from Sally and then from Nadia.
Thanks, Andrea. Thanks for the presentation and indeed the research that's been shared. So I'm Sally from Shared Interest, so one of the CSAF members. I think for us at Shared Interest, this research really helps give us that context, I think, to what we are doing as one player in this sphere. And I think also helps us in terms of the communications that we share with our investors. So perhaps dissimilar to many others on the call, our investors are members of the public here in the UK. So these are individuals rather than institutions or organizations. And the main reason for many of those people why they invest with us is for this understanding of the impact that their investment is having. And I think evidence like this and research like this really helps us frame what we can present in a greater context for them. So it's not necessarily about saying we as an organization are experiencing this or seeing these trends. It's actually giving us the evidence that those are trends or patterns that the sector is experiencing. And that builds, I suppose, a robustness almost to what we're saying. So I think research like this from CSAF is really valuable from certainly from that perspective, as I'm sure in many other ways that we can benefit from across the organization. So no, it's very welcome, and thank you to all involved. I suppose, like Paula, I did have one question that I'm happy to sort of share in the chat as well, because it's quite different. I suppose it was just whether IGC or anyone is able to signpost to similar research using the same sort of data, but from non-social lenders, to give a bit of context to see if there are any trends or patterns or similarities or differences. I think, again, maybe just helping to give a bit of context to the evidence that is being given here, specific to CSAF members, very much within the social space, but what does that look like in the non-social space, if you like? So just really interested if there's anything around that, but thank you.
Thanks, Sally. Maybe the IGC team can answer Sally's question in the chat and share the link to the literature review or any other points of literature that would help signpost to similar research. And then Nadia, please go ahead.
Thanks. Just really quickly, I mean, I think that one of the things that I would find really interesting to hear, especially from the social lenders and the impact investors in the room, is that if we see what we think is obvious, the longevity of the relationship result in better terms, et cetera, what would need to happen? What would you need to ensure that maybe in the future, maybe you hadn't, until seeing the evidence, hadn't realized like this is the term that it's taken to build that relationship. And I know, working in a network, that it takes time to build trust, to build relationships, to get things to a point where you're comfortable. But is there anything that we can do that can be done to accelerate that, maybe to like make that process a little bit shorter, or, so using these pieces of evidence that to then figure out how to maybe escalate or accelerate where that potentially can happen? I'd be interested to hear that from others if that's of interest.
Joffrey, I see your hand is raised. Do you have an answer to Nadia's question or another comment?
Yeah, thanks, Andrea. This is Geoffrey from Microcredit Kenya office. I think thanks for the presentation. And what drew my attention is the slight drop again on interest, irrespective of the long relationship we've had with our partner. Maybe I can discount this a bit. Because over the years, the cost of funding, the base rates are really acting up. So in some cases, you can even see an increase in the interest rate because the base rates keep on increasing. So maybe if you could look at the effect of increase in base rate vis-a-vis that slight drop in interest rate, maybe it is even increasing slightly over the recent years. So maybe it may be good to qualify what is the effect of increasing base rates, which I think is a major funding assessment for most CSAV lenders. The use of SOFR, the use of LIBOR, the previous LIBOR. Maybe we still get cheaper over time because we have confidence, we have a relationship, but still, if you look at the net effect, and because of the base rate, the interest may not be coming down as expected. So I just want to qualify that. Thanks, Andrea.
Yeah, thanks, Joffrey. I think maybe the IGC team can address that in the chat. I see a couple hands raised, so I want to keep the conversation moving, but I feel that Christian likely has a really clear answer for this. So I'll invite him to answer your question in the chat. Chad, I see your hand raised. I'd love to hear from you as well.
Yeah, thank you, Andrea. Thank you, CSAF, for doing this. I find it very interesting, and Rania for the presentation. I wanted to try and answer. I'm Chad Sachs from Nest, and we primarily lend in Latin America and Eastern Europe. I wanted to try and answer Nadia's question because it was one of the questions I had about when you look at these trends, for example, when interest rates are going down, or lenders are more comfortable, I feel like a lot of the researcher focuses on how the company is taking actions to encourage that behavior. So they're becoming less risky. They've shown that they can do certain things. They've generated that confidence. I guess I wonder, it's a two-way street. I also think for investors, there's a lot of reasons that happens as well. Like the transaction costs are much lower if you can just repeat your business, right? You're willing to probably tolerate a reduction in interest rate to just renew the line, or the diligence is much faster if you've been working with these companies for several years. And so I think there's incentives by the investors as well. And I think Ronnie was asking, maybe there's more information around that even if the borrowers stay exactly the same, lenders may want to improve the situation as well, just from their own benefit. And I think that might influence some of these results as well. So I think both sides. But so then Nadia's question is, for example, if you could come up with ways to make diligence easier, would people be more willing to move faster instead of waiting 4 or 5 years to start reducing or increasing the amount of the exposure? Or if you could address some of those friction or transaction costs, maybe some of that improvement of the conditions could happen faster. Just an idea.
Thanks, Chad, for that input. This is really helpful. And I also saw a question in the chat, or a comment rather, about how CSAC can use this evidence to lobby for guarantee funds or other catalytic capital. And I do see that we have several representatives from World Bank, DFC, foundations, and other multilateral organizations on the call. So I would love to turn the conversation to that group of practitioners on the call about what type of evidence is most valuable to you as you're making decisions on how to allocate catalytic capital. I saw Laura had her hand up earlier, so Laura, maybe if you're available to weigh in on that question.
Yeah, hello. My name is Laura McKenny, and I'm actually former World Bank. I was at IFC, and I was head of the Global Agriculture Food Security Program, private sector window. And I'm still engaged with that program, which has been a successful program in getting a large investments over about $2 billion worth of investment in the agri space. But what we're trying to do now is launch a new track for business financing, and it's to support private sector support of agri SME financing. And our what I'm very interested in, and I really appreciate the work that's been done, is the link between the catalytic money, which we maybe we call concessional finance money or blended money, the softer money that donors can provide, and these are government donors normally in the space that I'm working in, and it can be large amounts up to 300 million to 500 million. The link between that catalytic money and then how it affects first of all, non-distortionary in the marketplace, which I think we see, but the evidence there is important. And then, of course, how then it affects the ultimate beneficiary, the SME. So one of the questions that I have actually right now, because we are designing this new financing window under GAP-SB, again, called the Business Investment Financing Track. One of the questions we're grappling with is, at what level can you see more impact? And the question is whether it's at the transaction by transaction level, like working with individual, either financial institutions or individual lenders or agri-finance providers, versus working at a system level. And we're trying to we're leaning toward the system level approach, but I guess sometimes we struggle between when you're trying to attack or at least trying to see what the system level issues and problems are, and really addressing those in a country. Does that become too bureaucratic and too many layers, and kind of undermines the effectiveness of working with one individual player or one individual financial institution? So right now, that's what we are kind of working to try and sort out. Again, we are leaning toward the systems approach, and any evidence that you can provide, going forward, how that catalytic money in a system level, either fund or facility or program, can then still show connecting the dots to show that the underlying beneficiaries are positively affected. Thank you.
Yeah, that's a great contribution, Laura. Thank you. And I think that there's also an opportunity to kind of reverse that question and ask, when you are lending to specific agriculture SMEs, are there spillover effects that are affecting the whole system? I think there was some studies that were done a couple of years ago that tested whether the average payment to all farmers in a region increased when a few of the cooperatives in the region received access to financing and higher prices. And I think this was a root capital study, but I don't want to be mistaken. So we can try to look for it after the call. And I think that there's a lot more research that can be done as well in understanding both the impact at the system level, the impact at the agriculture SME level, and any spillover effects that come out of either of those relationships. I see there's a couple of questions coming into the chat, and I also want to invite any other participants on the call who might have an answer to Lara's question or additional input. Jean-Marc, I see your hand raised.
Yes, Andrea. I think generally speaking, the appetite of impact investors like ourselves and others will depend on our capacity to mitigate the risks that we are facing. And what's very interesting is, of course, that since 2020, we are in an environment of multiple crises, compounding crisis. And allow me to plug in a research paper that should be released soon, mandated by IFAD with ISF, Altafin and other CSAF contributed to that paper. And it's about the polycrisis affecting African agri SMEs in particular. So you're looking at the impact of climate change on these agri SMEs, but also COVID, Ukraine, the stagflation, and it's not looking pretty. And so I think what you're seeing is that the challenge that we had before that was highlighted by numerous research papers, including this one by the IGC team, is going to be even greater going forward, because these crises that we are processing right now have not been fully priced in. And you're going to see a continued, I think, increase of non-performing loans, and especially for the smaller agri SMEs, the one that not too many people are keen on financing. That's also what I wanted to mention by something needs to change in the equation. Okay, it's urgent right now. So a lot of this concessionary capital needs to target specifically these ones.
Thanks, Jean-Marc. I see Peter has a hand raised. I would love to hear from Peter about what you're looking for, or what kind of evidence do you need to make decisions on how to allocate catalytic capital, and then to also build off of Jean-Marc's comment, perhaps after Peter speaks and before we wrap up the call, I can invite Rocco to share more about additional research that's taking place, how SLE and IGC are evaluating the link between catalytic capital and incentives and access to finance. So we'll start with Peter and then jump to Rocco. Thanks, Peter.
Okay, thanks a lot. My name is Peter from the Swiss Agency for Development Cooperation, bilateral donor. I'm going a little bit in the direction of the lady from the World Bank. Our mandate is poverty reduction and reduction of inequality. So we are interested in what is happening at the level of the farmers or the suppliers, clients of these SMEs. Are their livelihoods improving or not? So first question for us is always additionality. Is our catalytic capital additional or not? If it's not additional, then the scarce public money shouldn't be spent, of course. So high additionality, medium additionality, at least some reasonable and plausible additionality needs to be there to justify our engagement at all. And then it should somehow translate into improved livelihoods of our target groups. And that's the evidence we are missing. We know there's no precision possible. No farmer knows himself what's the net additional income of his cooperative receiving a loan, but there are still some ways to get this clearer. And the more plausible, the more clear we have this, the easier for us it is to invest. So if you can say me, thanks to catalytic capital, I'm giving more money to an SME, and this SME is buying more from farmers, and this is really translating into a profit for farmers and improved livelihoods, then that's what we need. And that's up to now, it's not that strong. There are so many studies and so many reports, operational reports, and the evidence is not super scientifically sound. We would need more, at least something that is sufficiently plausible. Okay, no scientific precision possible if farmers don't have a financial accounting and things like this, but something that gives you the comfort that if you go to this direction, this is really translating for our target groups. That's very important for us. Thanks. Sorry for talking too much.
Thanks, Peter. I really appreciate your perspective, and I think this is a great time for Rocco to answer some of these questions about where what are the future research that we can do? What are you currently doing in order to identify the evidence around catalytic capital and additionality?
Yes, thanks. First of all, sorry, I was a few minutes late due to another different talk I was giving just before, but it's great to be at this event. And so let me reply to Peter and indirectly to Laura. First of all, we completely agree. The evidence is very thin. Now, there is that one study that was done with the root capital data. Now it's a little bit outdated now, that study. But that study that is being published in the one of the leading economic journals, the QGE. And in that study, what we were able, I was an author, so I will talk liberally about it. So what we were taking advantage of is the fact that, well, of course, it's not possible to do experiments on very large loans, but because of the scoring system that Root Capital utilized at the time, enterprise with very similar characteristics end up getting different loans of different size with a difference of about $100,000. And that is called a regression discontinuity design, which kind of is meant to approximate the rigorous experiment that we have in mind that has proven so elusive. So what that study actually did show is indeed the case that the extra loans were additional, in the sense that it's not that these firms were using these extra loans from Root Capital to substitute other more expensive sources of finance. So there was an expansion in the credit available to the firms. And then this expansion could be traced to an increase in the prices received by the farmers. This second part, the data were really, you couldn't push the data too strong. And so this is part of an analysis that ended up being in the appendix of the paper because, yeah, sure, you can show the evidence, but it's not maybe as rigorous as we would, or, it's not as robust, we felt, as as it would have, if we had to put it at the center of the paper. So this is just to say that the first two links, this is the only evidence that I'm aware of. And one could imagine, and this is a fairly outdated study, because I think we were looking at the portfolio up to 2010 or 11 or something like that. So it's quite old. It would be great to update this analysis. I think it could be done, and to strengthen a little bit that evidence. And then with more data, also one can maybe get a slightly more nuanced answer. So that with regard to the additionality and then the farmer impact. One could imagine also different research design, but they would be significantly more, if you like, expensive. I mean, the beauty of this Root Capital study was that we were simply using the data that Root Capital, amassed just to perform their lending operation, and it was very good data and very useful. And so this is also a general example of where there might be a lot of data already sitting around that could be used and so forth. Now, the second thing is what we are doing now with ASELI. So the IGC is one of the monitoring and evaluation partners for ASELI. And so ASELI is a fund, and the idea of the fund is to provide incentives in a variety of ways to lenders to increase their lending to agricultural SMEs. The evaluation is ongoing. We are basically collecting data to check whether indeed the incentives are effective in expanding loan access. It would be way too premature now to say that we have evidence of that sort. In fact, we are still kind of at the planning stage of exactly how to collect the data. As you can imagine, this is very, very tricky. There are a couple of different things that we are planning to do. But I have to say that if you just look at the growth of the portfolio of loans in ASELI, I mean, it's my prior is that there is an effect, and that is a question of whether the data, the available empirical strategies or sufficiently rigorous empirical strategies will be able to pick it up, because there's a question of sample size, there's a question of how precisely you can monitor outcomes and so forth. So to address those challenges that are primarily of sort of establishing counterfactual and relaxing measurement constraint. So on the counterfactual side, we are trying to do an experiment where with one bank, where the access to incentives is kind of randomized at the loan level. And then we check whether that incentives at the loan level change the financial decision of the bank. There's also a more higher level approach where we basically trying to collect data from the credit registry in some of the countries where SELI operate. So those data gives you the universe of all loans in the economy, or at least all formal loans from banks in the economy. And then you kind of try to exploit the fact that not all banks joined a SELI, the fund, at the same time, and therefore became eligible for these incentives at the same time. And furthermore, not all the banks have portfolio in the same localities in the countries. The network of agricultural SME that these banks reach is kind of different across branches. In theory, to kind of try to trace whether the eligibility for incentives was indeed accompanied to an expansion in the supply of credit to this portfolio, to this segment of firms. And so these are, I think, are obviously more expensive, very ambitious sort of measurement and exercise that are ongoing. You can see why they might go wrong in the sense that the measurement is extremely challenging. But if they prove to be right in the sense that we gain confidence that the measurement could be pulled off in a sufficiently rigorous way, and then we had evidence that indeed the concessional capital was indeed leading to an expansion in the supply of funds, then I think that combined with the results from the root capital study, then we would start having a little bit more rigorous evidence on the entire chain that Brian sketched. But just to reiterate, I agree with both Peter and Laura, but yeah, these are kind of the $1 million question. And though we are working on it, I think there's a lot more that can be done.
Thanks, Rocco. It sounds like we need another hour to add to this call to keep digging into the research that you're doing, the research that other people would like to see.
Oops.
Apologies.
Dropped off the call.
Yeah, I lost my internet for a second, but I think I'm back now and just here long enough to thank everyone for joining. And we think this is, the very first step of something that can be much bigger and much deeper. So we're looking forward to having everyone on board and engaged as we move forward these efforts to build evidence. I think it's very clear from this call that it's needed, that it's relevant, and that it's critical. So thank you for your participation today, and thank you in advance for your participation as we continue to move forward in these efforts.
Thanks very much. Bye-bye.
Thank you.
Thank you. Bye all.
Thanks, well done.